we now have our final presentation, which is Ayan Mitra from CrowdBnk.
Good evening, guys. The advantage of going last is I don't have to go through the industry stats. I think my fellow speakers have done a fantastic job of doing that. So I thought we have some slides here, but I'd like to focus in on our learnings in the industry over the last 3.5 years in terms of where we started, what we've done, what we're finding when we're actually working with investors and entrepreneurs in the UK and to some parts in Canada and Dubai. Just before I set off, how many people here have started businesses or are about to start businesses? Okay. And how many people invest in businesses or have used crowdfunding platforms before? Okay, great, good stuff, good mix. So a little bit of my background. My background is tech, and I think it was touched upon. I used to run tech teams for HSBC before internet banking became the norm, so it's sort of mid-90s. And then I switched to Marks and Spencer's, rolling out EPOS systems in shops up and down the country. And then finally I had sort of 8 years in Orange, which is now everything everywhere or nothing nowhere, however you want to see it, running sort of broadband and mobile teams. And towards the end of my career, I got involved in sort of corporate M&A and corporate venturing, and I helped some startups raise funding the traditional way. And I don't know if you've done it yourself. It was excruciatingly painful, stressful, and inefficient. That led me to believe that there's got to be a better way of doing this. And I found myself in New York in 2010, before Kickstarter has become the rage that it is. And I famously remember predicting at NYU that Kickstarter would never catch on, because I couldn't understand why people would give money when there was no legal tender behind it. I was clearly wrong. They've done $525 million in 3 years. But when we looked at that model and applied it to the PE/VC industry, we found that we felt capital distribution was inefficient at the stage of low-end seed capital to 2 million or thereabouts. Because at that time, angels were becoming more risk-averse, like the banks actually, and people were going for more repeat funding in their existing portfolio rather than give more risk capital. I'm not sure whether you've read the Chris Rowland's report that came out in 2009. It's been followed by the Tim Breeden, the Breeden Task Force, which roughly says 59 billion pounds of funding gap in the next 5 years in the SME industry. And that's widely, generally, viable businesses trying to access capital, not getting it at their terms, and as a result, not growing or dying. On the flip side, we sort of looked at who is actually investing in funds, in equity markets, and why, and whether the traditional investment vehicles and institutions were talking to them. And we found, and that number has moved, this is a couple of years old, 3% have meaningful access to equity investments, which is a small number. And for all the conversation that is going on in crowdfunding and institutional investment, traditional investment, you're talking about a small number of individuals here, so roughly 500,000 out of a 63 million population in the UK, just to give you a frame. We did some research, focus groups, and figured out there are people like you and me who were not tapping into the market because nobody was talking to them. Roughly, we feel that's about 14 million people who have some disposable income, would like to engage, but do not get the opportunity or the time. So that's sort of the funding gap that we talked about. But then we started looking at why aren't people investing and why aren't businesses getting their money. And number one reasons is ideas and SMEs are not investment ready. And I didn't believe that until we've gone through over 200 businesses and business plans and entrepreneurs. And there's some laughable stories versus there's some pretty good businesses, but not the wherewithal and know-how and network to present it to investors. And largely, the rejection rates and the way the gatekeeper models work is you have an associate at a VC firm or a traditional PE house who has a basic criteria that has to meet the ROI or the sort of the investment strategy of the company. If you don't comply, you fall out. And when you fall out, these guys don't have it, or they're not incentivized to sort of point you in the right direction or give you homework or 101 so you move forward. Personally, we raised money for CrowdBnk through a private crowdfunded round of 30 investors. It took over 1,000 conversations before we got there. Our platform wasn't beta at that time. So it's very time consuming. And for regulatory reasons, that 14 million retail market is off the chart. So a lot of the players out there at the moment is high net worth individuals only, sophisticated investors, venture capital contacts, professionals. But we felt crowdfunding, for it to work, and the reason Kickstarter works, and they have the only, well, Kickstarter and Indiegogo, they're the only two statistically significant data drivers out there in the rewards space, Kiva in the sort of debt space. You needed to include the crowd, and effectively, right at the outset, we said we would only trade if we had unrestricted retail permissions, very similar to like an IPO, where we could go to the public to sell investments that we financially approve. So that's what we've sort of built. We'll talk about it a little bit more. But the rest of the reasons was high cost of transactions. There's loads of intermediary boutique corporate finance houses who would charge £2,500, £5,000, £10,000, £50,000 in order to produce an investor memorandum and then open their black book to you. There's no guarantee of funding. You have to pay that upfront fee for them to work with you. And they generally have 1,000 to 2,000 investor base, generally high net worths, some ultra high net worths, some angels. There is no exclusivity in general, what we found, and their funding rates were questionable. There was not a lot of data available, but what we found was you paid, and then if it doesn't work, it's your loss. You move on and find the next intermediary. And then finally, most of the businesses are really scared of equity, and which is why equity represents a really low percentage of financing, purely because people have this idea that, oh my God, it's like a public company, stock exchange, it's a nightmare managing shareholders. I'm better off taking debt. They're scared of managing shareholders. And that's linked to financial literacy and sort of inclusion, if you like. We think we could do a better job as an industry to educate people outside the industry to come in, make better choices on financial decisions. I'm not going to do crowdfunding because we've done it. Not going to do that. Why use crowdfunding? Well, for investors, it's access to otherwise unavailable early startup and SME opportunities, low capital requirements, very social. For businesses, alternative means for capital sometimes, and I think the industry is pretty much shaped up like that there is no upfront fee. So basically that your risk is lower, barriers of entry are lower, and standardized template legal documents to fit sort of deal types. So our vision. So we kind of call ourselves on purpose an online platform that helps businesses raise capital. We want to fulfill £2 billion of capital in the next 5 years. We want to improve financial literacy and inclusion. And the reason why we haven't got crowdfunding in there is purely because we think that we are here to add value to the entire ecosystem. Today it's called crowdfunding. It may be called something else in 5 years' time. But what we have built is a more efficient, transparent, trustworthy way of facilitating transactions between entities. Now, it's the same old concept of risk and reward. It's the same old concept of negotiation on a P2P basis. It's just underpinned by a technical platform and kind of gold-plated regulatory compliance, corporate governance to ensure that anything you see has gone through that step of due diligence before you touch it. So why are we different? So we actively support businesses to produce the investor memorandum. This is almost a corporate finance function, which involves investment bankers, involves accountants, involves lawyers, which in the end produces investor-ready business plan or investor memo, which we then approve as a financial promotion, which we can then sell the investment to anyone. That's the difference. FCA compliance, FSA, basically allows us to do that, and there's no exemption. We are not limited to high net worth, sophisticated professionals. It's retail. Legal structure, we actually incorporate the Companies Act piece around the spirit of crowdfunding is if you're going out to the public, there is very clear direction what structure you should have in terms of trading corporate structure. So we have a PLC structure that we will help. It's a stripped-down PLC structure that doesn't require the costs that you would normally associate with that, but nevertheless it has corporate governance and reporting such that investors can rest assured that their money is being managed a little bit better. Transparency, so you can either directly own the shares, or we have a custodian arrangement because VCs tend to like that. They don't like a lot of entries on the share cap table. That makes them nervous. So we can roll all of that individual investors into a single line. And then finally, very importantly, post-transaction services is management of that investment going forward. We work with our partners to ensure that corporate governance, accounting, audit reports are done properly, such that it's not, here's my money, I take my cut, and I walk away, and then it goes peaked on. So how do we make money? It's a traditional intermediary model, 5% of success fees, 3% of payments processing fees. So we have, interestingly enough, integrated mobile payments using the faster payment system for Barclays. We have credit card, debit card. We can actually access 85 modes of payment. We chose not to because guess what? When we tried it out with data, the serious investors don't go anywhere near that. They use BACS transfer. They don't, and the retail investors, they do use it, but there are cost implications that we are factoring in because anyone who has to trade in this industry has to pay MasterCard, Visa card money. They don't waive anything off for anyone. You may get some volume discount rates. And then 1% legal expenses. So effectively, we take care of all of your shareholders' agreements, subscription, articles of association, incorporation, any underlying tax issues, employment. It's not an open-ended, amazing legal thing. There are basic templated documents, and you can have more if you want to. That's all I had to say. I'm just going to finish up with what I've been involved with today. So what we found was we have a bunch of ultra-high net worths on our books, which is more traditional, about 15. Their ticket size is about 200, 250K a pop. They do not deal with Facebook, LinkedIn, and email. So to get them, I meet with them once a month over coffee, beer, and 3 or 4 times they'll eventually meet the entrepreneur before they commit. Now it's very evident, and I had some data from Goldman's to suggest that wealthy individuals are in that space whereby that's what they're comfortable with, and it'll be some time before they move that they're making 150 grand commitments on a crowdfunding platform with no physical contact. So today we had template documents. It was that close to closing the sort of ultra high net worth part of the campaign, and 3 investors came in with their own clauses in the shareholders document, which then escalated into a full-blown traditional corporate finance last-minute teleconference to close it. The point I'm trying to make there is that was not included in sort of the plan, but we had to deal with it. And the reason it's important is largely if you look at small amounts of money coming in from a large number of people, we think the blend of a large investment, so this was a £700,000 investment, it will come public in about a week's time. It'll be fulfilled by quite a lot of the traditional investor base who will take some time before they come onto the online platforms or are comfortable doing that. So we've tried to build something that bridges traditional investment industry to online to make it more efficient. And one final point on banks, I have 1 minute, 30 seconds. We are working with a lot of the banks in terms of whether we can help people they cannot lend to. The big learning for us was my system was amazingly automated when I started about 18 months ago. It has gone more manual, and it's going to go more manual. That's our learning, that you cannot change people's perception and behavior. It takes decades before people are comfortable doing what we think crowdfunding is possible to back. So I think over 5 years we might see a shift, but for now it'll live very nicely in an ecosystem that bridges traditional and new age, the new finance. So thank you.
Thank you, Ayan. Perfectly timed. Do you have any questions for Ayan? No. Okay, take one.
Good evening. My name is Michael. I work in a bank, actually. And I have a question about the first slide you showed us, the one where there is a big empty space in the middle that you call your opportunity zone.
Yeah.
How come no one ever went there, if it's there, and if it's 59 billion pounds?
Very good question. So I think it's a combination of a number of things. I would recommend reading up the recommendations from Breeden report. It's publicly available on the UKTI website. But what they found was, I think there was over-reliance on traditional forms of investment, i.e. bank lending, at the time whereby credit rules and risk aversion, those sort of things were loose. So, and I think gentleman made a point about banks were lending to people they shouldn't have lent because they didn't match their risk profile. So largely, a lot of the SMEs, I think there's 25,000 viable SMEs out there, they take their decisions based on their accountant's advice and their legal advice. They generally don't have CFOs and so on and so forth. So therefore, the only thing that they know is the big four banks in terms of the adverts. They don't know we exist. And frankly, they don't have the time to go and find out what their alternative finance is. So as a result, so there's accessibility and deal origination issues there, which doesn't directly relate to 59 billion, but essentially the mismatch between what is available and who's willing to invest and who you can see. So for example, the banks were willing to give you a loan for 100 grand 6 years ago. They're now not willing to give you 100 grand. Guess what? You don't know where to go. As a result, you either sit there and live on your cash flow, or if it's going bad, you start to sort of die. And then, so there is no ecosystem out there, and which is what we are trying to do as new finance and crowdfunding, to get out there to say there are alternative means to actually access finance. So that's where the gap is. The other piece is risk and return. So VCs sometimes used to put in there, but these days they've just drawn up and they're repeating their portfolio for large investments. This is not quite typical in the States, whereby the angels have come in, and the VC and the angels, the FINRA piece, is both $20 billion. So it's quite different here. So I hope it goes towards that. We can talk more if you want.
Quick follow-up, if I may. Are you seeing more new projects, or are you refinancing people who are struggling? Which one are you doing the most?
Refinancing people, sorry?
Are you refinancing existing businesses the most, or are you funding new businesses the most?
We have seen an interesting thing. So initially, in the first 4 months, we got a lot of new startups who were looking for seed and growth funding. Of late, since we've gone up and did some marketing ourselves, we are now getting established businesses that are doing 2.5 million a year revenue. But it isn't essentially refinancing. They're actually trying to grow. So this particular deal we're talking about, they have a site, they make 2.5 million, they have been approached for another 2 sites. They need capital to grow that, and we are raising that for them.
Okay.
Hi, my name is Ben. Question is, to what degree are you requiring ongoing transparency? I don't know. I think you alluded to. I don't know if there's management accounts or some sort of oversight that investors get access to after they deliver.
Yeah.
And my other question, and then related to that, is what was the response from the SME management to having to now open up books or be more transparent to potential investors?
Good question. So I think it's a little bit of a mixed bag. I think there's a level of apprehension with regards to SME management to say, I'm going to open my books to investors. But once they realize the underlying value and the sellability of the business and the attractiveness of the proposition makes a massive difference, they come around to it. And the other angle to think about is they think the corporate governance requirements that we try and impose has an associated cost with it. But we have an answer for that, because we have a top 20 accounting, or 3 top 20 accounting firms providing very affordable services that in the long run enhances their value proposition rather than get them exposed, if you like.
How do investors get the money back out?
Very good question. So liquidity comes up quite a lot. So, and I think crowdfunding essentially, or crowdbank for that matter, materially doesn't change the fact that we are actually dealing with patient capital. It's a little bit different for sort of debt in terms of expectations from the investors as to how they get their money back. In general, most of these funding opportunities come with the Seed Enterprise Investment Scheme and the Enterprise Investment Scheme tax efficiency breaks, which has a 3-year timeline on it. If you get sales proceed within that, you do not get your tax break. So at a minimum, you would expect that you don't get out before 3 years. In terms of liquidity and exits, most of it would come from secondary offerings when the company hits its milestones and significant institutional investors come in. Then the small investors would get a chance to get out. Now, we have preemption rights and rights of first refusal built into our term sheets, but as it turned out today, some people want it, some people don't. And because we are actually working with co-investment partners, we've signed up 2 SEIS funds, 3 EIS funds. We are talking to 5 VCs who are going to come in on some of the rounds, which are starting to go from 700,000 to 1 million to 2 million for businesses that are already generating revenue. The easy exit is the institutional investor then mops up when it's confident that this business is going to go off. But we have considered a secondary exchange. It's been discussed in the industry quite a lot. We have the tech to do it. Until we see the appetite, we're not going to execute on it because there are regulatory implications of effectively we start to look like an MTF. We don't want to do that.
Hi, so I have a question for you regarding the age profile of both investors and lenders, because what we've seen in previous research is that social media and being online and everything is more of a new trend and a younger investor trend. Do you see that on your end as well? Do you see a shift between the old generation, quote unquote, and the new generation from either side, actually? Sorry,
can I rephrase it? Do you think, are you asking the question whether we see in our data they're behaviorally different from social media?
Because more and more young people, quote unquote, i.e. people who grew up with internet and social media have no access to funds that they can invest in that type of scheme. Do you see any shift between them and their parents, in other words, or their parent generation?
Yes, we do. I think it links back to what I was saying about the investor pool averages is actually quite skewed. So I think a lot of the platforms come out with averages. We have 10,000 invested and they're doing average of 2,500. I think that represents an incorrect view of how the industry is working. And the industry is very much, I have 262 investors doing 100 grand each, and I have 3,000 doing 500 quid each. The behavior of these two segments is quite different. Generally, I mean, it's statistically not significant, but the younger, smaller man group are more savvy to sort of social media and more comfortable, and the traditional investors would, even though they use Facebook, there's clearly an emergence of a new generation coming onto Facebook, wouldn't use that channel to do this transaction purely because they're not comfortable with it.
Just as a follow-up, I mean, do you market the concept to them differently, or do you try to target the younger population more than the older one?
Yep.
Okay, Ayan, thank you very much.
Thank you.